Well, let's bring in Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago, for a bit more on those moves. Larry, always a pleasure. Thank you so much for joining us. Just tell us a bit more about the move that you're making with respect to the oil price. Some are sceptical that we might see a pullback here, but first and foremost, the reasons, in your opinion, as to why the recent oil price has been so strong.
Yeah, I think it's there's three things that are going on in the oil market, and most has been going on since summer. And fundamentals, non-fundamentals, and then also just the supply and demand. But starting with fundamentals, you see you have a time where the demand continues to be strong. In 2017, we've had supply disruptions, North Sea, Venezuela, etc. They've had some real disruptions, and so that's really caused us to tighten up, caused the market to become very tight, and therefore we rally. The non-fundamentals are just as clear. You have managed money has been net long. The underlying since July, there's backwardation in the curve, and that creates a positive roll environment, and the weaker dollar, that all helps build momentum for the pricing. And beyond that, you just have the geopolitics that really have not been an issue until recently with the Kurdish independence. You have Venezuela, which has had a real disruption, not to mention Saudi Arabia and the economics there. So it's been three legs of a stool. It's been keeping the price up, but I do believe the prices are overheated and due for a healthy correction soon.
What about for iron ore? Because we heard that story there with Barclays forecasting quite an imminent sell-off in the iron ore price, perhaps back down to $50 a tonne. Do you think that we'll also see some further weakness here as, those steel mills in China recede and growth perhaps starts to come off the boil a little bit? Where do you see the iron ore price going?
I do see a short-term correction in iron ore, but the difference is a short-term correction is I would buy any short-term correction price in iron ore because I do believe the price will remain constructive in 2018. And I know I'm going against most consensus, especially my friends in Western Australia, but I do believe that China will continue to be a tight market, and it'll at least keep the supply. It'll be a volatile range, but it'll be a tight range. And I don't see the price going down the 10 to 30% that most people are calling for.
What about for gold? It's extended its post-December FOMC rally into 2018, and it's once again breaching the $1,300 an ounce mark. And we know that obviously the weakness in the US dollar has been very supportive of the greenback. The weakness in the US dollar, I have to add, has also been quite surprising. But your view on where you see the gold price moving from here?
I still think gold is going to trade lower from here. The reason it's gone higher, you're correct, is the weakness in the U.S. dollar. It's down about a 1.5% this year, but it also implies the flat yield curve and the terminal rate in the U.S. not changing, or real rates actually have gone lower, if not, not higher like most people are suggesting. So that's keeping the price up. But at the end of the day, I do think it's traded as a precious metal recently, and I think it is due for a little bit of a correction. I wouldn't mind seeing it down around the 1250 mark. That's where I would be a buyer.
Speaking of corrections, what about for the broader market? We've been seeing another milestone reached there today for the Dow Jones. There's obviously a lot of optimism as we head into fourth quarter earnings season that it will remain supportive of the market. What do you think, though? Do you think markets and prices are starting to look overheated and we're at risk of a pullback here?
Yeah, I guess, we've looked overheated for years, but on an absolute level, stocks are expensive. On a relative level, they continue to be of value, especially when you compare them to corporate credit or government bonds. So I think the stocks will remain semi-constructive around the globe. Fourth quarter earnings season is going to be it's going to be a mix. The hurdle rate and the revisions are lower. You look at MSCI Global, the revisions are at a 14-year low. It's stunning to think, and I do believe there'll be pockets of the market that won't do well when you consider the euro rallied 9% in the fourth quarter against the greenback. That will hurt the pockets. It will act as a headwind. But on the other hand, you have tax beneficiaries. You still have financials who are relishing on the whole rate environment, and in my mind, the valuations of the financial sector, broadly speaking, are a value compared to the rest of the market.
And what about particular sectors within earnings season that you'll be watching closely? I know we've already kicked things off with the banks today. It was good to see outside of the banks with United Health doing quite well there. What sectors do you think perhaps will be the outperformers and might get some re-ratings after earnings season?
Yeah, you know, my sectors remain the same, and they've been this way for almost 6 months. That's overweight financials, especially in the Eurozone, followed by commodities, not just energy, but commodities as a whole. I'm staying away from defensives. I just don't think there's a whole lot of value in being long staples, utilities, semiconductors, et cetera. So I think the whole rotation into value from growth makes sense. That's something I called 6 months ago. I had egg on my face 6 months ago, but right now it seems to be coming to fruition.
Just a final thought on the US dollar, and we know that there has been that weakness, and that's obviously been playing into the commodity moves there, but it's been at odds with, you'd have to say, rising interest rates, which you would think in a rising interest rate environment you would see that the currency benefiting, but you haven't. I mean, it's been weaker at this point. What do you make of it,
Yeah.
and do you see further weakness for the greenback from here?
Yeah, I think it's too simple. Real rates in the U.S. actually have gone down, as evidenced by the flat yield curve, implying that terminal rates are unchanged, not higher, as most people would think. And also, there's been a huge, it's astounding, the amount of economic data coming out of the U.S. has been good. Some of it's been actually great. Like, look at the retail sales, CPI has been okay. But when you look at things like Eurozone employment, the way it's dropped so fast, and just the speed of their data and how much it's improving and how fast. So it's going to be really hard for the dollar to rally on that, even though I was calling for a slight rally in the first quarter of 2018.
All right, fantastic. Look, Larry Shover, we'll leave it there. Appreciate you joining us today, though. Thank you so much.
Thank you.